Hey, welcome back to the channel. Whether you're a newbie investor or a seasoned pro today, we're diving into two big players in the world of investing, REITs and ETFs. You've probably heard these terms thrown around, but what's the difference? And more importantly, which one is right for you? Picture this, you're at a buffet and you've got two trays, REITs and ETFs. Both look delicious, but you're wondering which one's going to give you more bang for your buck. Well, lucky for you, we're going to break it down so that when it's time to load up that tray, you'll know exactly what to choose. By the end of this video, you'll know exactly what each of these is, how they work, and most importantly, how to choose the right one based on your goals. So let's dig in, but first, if you're ready to level up your investment game, make sure you hit that like button and subscribe to the channel, and share this with a friend who needs to know the difference between REITs and ETFs. Trust me, they'll thank you later. Let's start with the basics. REIT stands for Real Estate Investment Trust. So what does that mean? In simple terms, a REIT is a company that owns, operates, or finances real estate properties, like shopping centers, office buildings, apartments, and hospitals. They pool investors' money to buy and manage these properties, and in return they pay out dividends to investors based on the income generated from the property. So instead of being that person who dreams of owning a mall or a hotel but can't seem to get their foot in the door, you can just invest in REITs and enjoy a slice of the real estate pie without actually owning the buildings. It's like renting out an apartment without dealing with the tenants. Now that's my kind of investment. But there's a catch. REITs are required by law to pay out at least 90% of their taxable income to shareholders as dividends. This is great if you're looking for consistent cash flow from your investments. However, it also means that they don't reinvest a lot of their profits back into growing the business. That's why they're typically seen as a good source of income, but not necessarily huge capital growth. Now, REITs can either be publicly traded, meaning you can buy and sell them just like stocks on the stock exchange, or private, which are more accessible to accredited investors. Publicly traded REITs are more liquid, meaning you can sell them quickly if you need to, while private ones are a bit more tied up and harder to sell. Alright, now let's talk about ETFs, or exchange-traded funds. ETFs are investment funds that hold a collection of assets, stocks, bonds, commodities, or even real estate, just to name a few. They trade on the stock exchange like individual stocks, but instead of owning just one company, you're investing in a whole group of them at once. It's kind of like having a basket of goodies instead of just a single cookie. And the cool part? You don't have to bake the cookies yourself. You just pick up the basket and boom, you've got a diversified investment. ETFs can track a variety of things like stock market indices, think the S&P 500, sectors like tech or energy, or even commodities like gold. There are even REIT ETFs. Yep, you heard me right. You can invest in real estate without actually owning property by picking up a REIT ETF. It's like buying a bunch of mini REITs all at once. One of the main reasons people love ETFs is because they're a great way to get diversification. Instead of putting all your money into one stock, an ETF lets you own a bunch of them. So if one stock falls, the others may rise, reducing your overall risk. Plus, they tend to have lower fees compared to mutual funds, making them a cost-effective way to invest. Think of ETFs like a potluck dinner. Instead of just making your famous potato salad, you get a little bit of everything, and you don't even have to clean up afterward. A nice way to build wealth with minimal hassle, if you ask me. All right, now that we know what REITs and ETFs are, let's dive into the key differences. First up, let's talk about what they actually invest in. REITs invest specifically in real estate, commercial, residential, and industrial properties. They generate income by leasing out space or through property appreciation, and that income is passed on to you as dividends. ETFs, on the other hand, are much broader. They can invest in stocks, bonds, commodities, or even other real estate investments. An ETF might hold hundreds, even thousands of different assets in its portfolio, so ETFs are more diversified and can cover a range of industries, making them a good choice if you want exposure to a broad swath of the market. Another key difference is income generation. Since REITs are required by law to pay out a significant portion of their income as dividends, they can be a great option if you're looking for consistent cash flow. On the other hand, ETFs may or may not offer dividends, depending on what they're invested in. So if you're after regular income, a REIT might be more up your alley. It's kind of like the difference between getting a paycheck every 2 weeks from your day job versus getting the occasional bonus for doing something awesome. Both have their benefits, but the paycheck is a little more reliable. Next, let's talk about liquidity. Both REITs and ETFs are traded on stock exchanges, so they can both be bought and sold fairly easily. However, keep in mind that if you go with a private REIT, liquidity may be a little more limited. So if you want something more liquid, an ETF might be a better option. Fees are another important factor. REITs typically have higher management fees compared to ETFs. Why? Well, managing real estate properties involves more work than managing a portfolio of stocks. On the other hand, ETFs are usually pretty low cost, making them more affordable in the long run. Alright, so now that we've covered the differences, let's talk about which one is right for you. If you're looking for consistent income from your investments and want exposure to the real estate sector, REITs could be a great choice. They're perfect for those who want to generate passive income and aren't afraid of focusing on one sector. On the other hand, if you want to build a more diversified portfolio, consider ETFs. They give you exposure to a variety of sectors and asset classes, helping you reduce risk and capture growth across the market. They're great for those who want to play the long game and are looking for growth potential. Think of it this way, REITs are like a single-focused diet. You're all in on real estate. ETFs are like a balanced meal. You've got a little bit of everything to keep your portfolio healthy. Choose what works for your appetite. So, there you have it. Both REITs and ETFs are solid investment options, but the right one depends on what you're looking to achieve. If you want consistent income and love the idea of real estate, REITs might be your best bet. If you're after diversification and long-term growth, ETFs could be the way to go. If you found this video helpful, make sure to hit that like button, subscribe, and share this with anyone who's stuck trying to figure out the difference between REITs and ETFs. They'll thank you later. And leave me a comment below telling me which one you're leaning toward. Are you all about real estate, or are you team broad market diversification? Thanks for watching, and as always, happy investing.